Hi YouTube. So today we're going to be looking at a couple of the key things that I look at when I'm going over a company that I'm considering buying, some basic concepts. And to do this we're going to look at a 10K, which is how companies report their financial statements, and specifically we're going to be looking at the balance sheet and the income statement today. There's also a cash flow statement, which is important, that we'll get around to later. And so a lot of these assets and liabilities are pretty self-explanatory. This video is more meant for someone who has a basic understanding of what cash and cash equivalents is, what assets and what liabilities are. Um, so first and foremost, a couple of the ones that are less known are accounts receivable, which is basically how much revenue is still owed to the company by customers, and accounts payable is kind of the inverse of that, how much they still owe to competitors or different companies for products. The big one that I want to point out that will probably be a video all by itself is goodwill and intangible assets. So your intangible assets are things like patents, things that you can't really convert well into money. Goodwill is when a company buys another company, they pay a little bit of a premium, and this is for like brand name, and it goes down in the balance sheet as goodwill. And the important thing to know about this is that it's not liquid. You can't change this back into cash to say pay a debt very easily. You would have to sell the whole company to get back goodwill. So the next main thing that I want to talk about is something called the leverage ratio. So the leverage ratio is total debt divided by total assets. Um, there is actually a better leverage ratio, which is assets over equity. So this ratio right here, total debt over total equity and total debt over total assets, these are big on Wall Street, but the textbook will teach you total assets divided by total equity. And this is basically a measure of how much debt the company has relative to other forms of capital. So you want to make sure that the leverage is fairly low, and we'll go into that a little bit further in a future video once we've explained the basics. So the next major thing that I want to talk about is the income statement. So there's kind of a waterfall going on here. So it starts with revenue, it goes into operating income, uh, which this particular part of the statement doesn't have. Oh, incomes from operations right here. And then it will go into something called EBITDA, which is earnings before interest, taxes, and depreciation. And EBITDA is the big one that a lot of people look at. I'm going to talk about the big one that I prefer over EBITDA in a little bit, but net income is after taxes, after depreciation, after all the other expenses. It's the actual income that they get. And the preferred metric that I like to use is free cash flow, where we take this net income and we subtract out capex, how much they're spending. Capex is how much they're spending on new equipment, on expanding the business. So you subtract out the capex to get the actual cash to the shareholders, and this is what we're discounting in our model. There's a big difference though in that free cash flow to firm will be this type of equation, but free cash flow to equity makes a small deviation in that it adds net debt issued. Because think about it, if a company issues debt, they can use that money to then pay a dividend or buy back shares. It's cash going to the shareholders. So this is my preferred metric to use, FCFE, free cash flow to equity. However, you can certainly use free cash flow to firm or regular free cash flow by just subtracting out capex. There's a couple of different ones further in finance, but for the purpose of equities, these are the two big ones. So the next major thing that we're going to look at is net working capital. So net working capital, it's useful in a lot of different finance equations that we'll go into later, and it's basically the amount of capital tied up in business operations. So the actual equation for this is accounts receivable, the money that's still owed to the company, plus the inventory, minus the amount that the company still owes to other companies. And so this is really the cash that they need to operate their business at any given time. So just keep that in the back of your mind when we go into other equations that you may see net working capital or see it on the balance sheet and not know what it means. That's what it means. It's not that complicated. So the last topic I want to talk about is return on equity. So the return on equity equation is net income divided by shareholder equity. And shareholder equity will be found in the balance sheet. So assets minus liabilities will equal equities because assets equal equities plus liabilities. So we'll see the equity right here, 251, and we would divide that by the net income. And so the equation is pretty simple, and this is where we derive a lot of the inputs to say this type of equation where we're valuing using the ROE, not a multiple or a terminal growth value. So this is where that number comes from and kind of the background into it. But basically you want to make sure that you have an ROE that is high, because higher ROEs mean that the equity of the company is generating more income. So think about it like this: would you rather own a a dollar that earns 7% a year or a dollar that earns 18% a year? It's really something like that, because the equity is the actual amount that the shareholders, the stock owners, own, and so you're measuring the return on that. So in the next video, we're going to go over bank balance sheets, the Fed balance sheets, and a little bit of macroeconomics so that we can start talking about different geopolitical and macroeconomic events that may impact the market in the future. Thanks for watching. Have a great day.